All right, so we have a final plan that I want you to look at, and this one is called Flexible Life. This is kind of a blend between your term policy and your whole life policy because it has a guaranteed fixed premium as long as you continue to pay the premium as indicated here. But it has a flexibility so that if you ever have a situation where you need to kind of stop paying for a while, you can do that as long as you meet the minimum requirement and you will be able to sustain the life policy. Okay, so let's first look at that flexibility. Currently, the plan requires that you have to pay this premium for 2 consecutive years. And then after that, you will be able to vary, meaning that if you hit the lottery, you want to pay it off, you could. Or if you run into a tight situation, lost your job, maybe putting money in, down on a new home, therefore you need to take a break for a while, you can actually let me know that and we can work with you on that as well. Okay, premium is also slightly lower under this plan. It's $18,000 a year instead of the $22,000 on the whole life plan. When you put the money in here, however, the death benefit is gonna be exactly as we indicated. Under this plan, it's gonna start at the $1,680,000, and it will remain that way unless you choose a second option, which is additional to the cash value. When we go that though, that premium is going to have to be a little bit higher. And if you want me to check that, I definitely can do that after we finish here. Okay. So here you can see we put in the $18,000 a year and already you have the $11,740 in the cash value. So that's quite a bit higher than the whole life policy. The whole life, they kind of hold on to that money and give it back to you in the later years. Here, you have access to it in the beginning, and so many people like that for people who feels like they need to access the money sooner rather than later. That being said though, because you have that flexibility, then the cash value is going to be a little bit less because they aren't able to hold the money and invest it long term. We do have a guarantee rate of return, and that's 2%. Right now, though, the market is bearing 5% for you, so it's a little bit higher. It will fluctuate. As the market goes up, you may see that interest rate going higher, but if the market lower, you also will not go below the guaranteed 2%.
Oh, interesting.
Right? Any questions there?
I do like this plan as well, so it's definitely a possibility.
Yep, yeah, they're all really good plans, so we
Yes.
definitely have to figure out which one fits best for your family.
Correct.
All right, so I want you to take a look at another component here. Is if you take a look, as you pay into that, you can see eventually the money you put in and the money you take out start to break even. For many people, this is where we can also start checking for people who say, well, I don't want to pay forever. Again, depending on the rate of return, we can actually take that return, pay for the death benefit so that you can stop paying. And sometimes, depending on how much you have accumulated in here, it will cover for the mortality costs, administrative fees, and all that. So you can literally stop paying into the plan and have it for life. And when I say life, I mean the policy lasts until 125 years old. Once you hit 125 years old, if you're still alive, you can see how much that coverage amount now increased to, and also the death benefit as well. We hand you a check based on your account value, and we say thank you very much for being a loyal customer. Here's $2 million that you can just go and have a party because you've lived that long. Okay, so Kevin, let's take a look at them again. For the term policy, it's going to be very economical. The premium is going to be guaranteed, and I reran this number for 30 years for you, if that works better for you. But you do know that at the end of that term, premium could go up higher, okay? On the whole life policy, the premium is higher. However, premium is going to be locked in for the rest of the plan or until you no longer need it. You do have dividends and you do have cash value, so that way it will become a living benefit as well as the death benefit for you. If you get to the age of 65, house paid off, children are grown, education taken care of, and all of that, and you say, well, now it's time for me to enjoy myself and my life, you can actually take money out of here and be able to utilize it for yourself. And if you do it right, it can be tax deferred and possibly tax free as well. Okay. However, once we are committed to this premium, you do need to pay for this until we are able to premium offset, if that's possible. And then there's the universal life, which is a blend between your term and your whole life product. The premium is fixed. as long as you keep paying the premium the way that we have it designed, then you will be able to enjoy this plan and not have the premium go up on you. However, you do have the ability to have some flexibility. So if you need to, you can decrease or increase premium. If you increase the premium, more of that money will go into your cash value and possibly also increase the death benefit. If you decrease the premium, then just understand that if you decrease it a little bit too early, you could affect the policy and you will end up having to pay more in the later year or continue to pay forever as well, okay? You do have accessibility to your cash value. Again, the same thing, depending on how you do it, it can be tax deferred and it can be tax free. It allows you to enjoy it as a living benefit. I have had many people that comes in when their kids need some money for college, pull it out, and then later put it back in and then save some more so that they also can enjoy additional money in their retirement. It has a lot of flexibility for you, okay? Looking at these three plans, which one do you think best fits your family's needs?
Well, they're all good. However, I think the best one for myself and my family would be universal life.
Okay.
Because of the fixed rate, but also being able to pull the money out if I need to use it, for emergencies or whatever reasons. So I think I want to go with that one.
Okay, so perfect. $1,500 a month is what the premium is going to be to get you started. How does that sound to you?
That sounds good. Let's do it today.